Today, not surprisingly, we're going to talk about income. Plato is very well known, particularly for our domestic income strategy, and more recently our LIC PL8. A number of clients are in the audience here. Thank you for coming and welcome. One of the questions that quite a few of our clients have asked us over the last few years, though, has been, look, Don, we love the income that you generate out of the domestic Australian equities thing. 9% since inception is great income. That includes franking, by the way. That's great income for retirees. But we know we need to put money offshore. We know we need diversification. But the income from offshore is lousy. It's like 2%. Can you possibly get, can you do what you do domestically in an overseas sense? And today that's what we're going to talk about. How to generate, or can you generate, and how do you generate high levels of income from a global equities portfolio, which is, from a macro point of view, is actually nice to be able to, if you can, get high income from global equities, because if we look at the macro environment today, and the latest CPI numbers in Australia came out today, and they're not going to change anything, income is still pretty hard to find. We showed this slide last year, and we've shown it for the last couple of years, which is what are the expectations for the cash rates here and overseas? Where are interest rates going to be? This is not our forecast. This is what the markets are expecting as of 30th of June this year. What we do is we look at the yield curve and we go out 5 years. What this is telling you, and Australia's the top blue line there, is the market is currently looking for about one rate rise over the next 12 months. My expectation is going to be next year, not this calendar year. So interest rates all-time low, 1.5% in Australia. Maybe they get to 1.75% over the next 12 months. That suggests to me that term deposits are not going to go anywhere soon. They're still going to be very low. And even out 5 years, it's saying there might be 4 interest rate rises. The expectation of interest rates is, the market's expectation is we'll get to 2.5% over 5 years. By 2022, cash rates here might be 2.5%. Now, I'm not saying the market gets it right. This time last year, actually, the market was doom and gloom and suggesting there'd be no interest rate rises for the next 5 years. It's actually got the first year right because we're still at 1.5%. The Trump bump and some discussions around that, and maybe some better news has meant that there is a slightly increased likelihood of interest rate rises around the world. Say more here in the US than anywhere else. Germany, Japan, and the UK and most of Europe, still the expectations are of low, even zero interest rates for the foreseeable future. So not a great macro environment, and that flows through to our forecasts. These are income forecasts, not return forecasts, but our income forecasts for the major asset classes from an Australian perspective. It is the case that a bog standard MSCI World global equities portfolio we expect to generate probably not even 2% income over the next 12 months after withholding taxes, and even less if you have to pay a manager fees. 1 year term deposits, the RBA, the latest numbers are 2.3% for a 12-month holding period. 10-year bonds have ticked up a little bit, but they're still sub 3% last time I looked. So, in fact, the problem with that 10-year bond, I've actually extrapolated, I've only assumed the income in the first year, but what it's really telling you is if I can buy a 10-year bond for, say, 2.6 or 2.8%, actually, if I hold that to maturity, I'm going to get 2.6 or 2.8% total return over 10 years. That's not a great return. That's an expensive asset, if you ask me. REITs actually Australian REITs have sold off a bit, so their yields have gone up, 4.7%, pretty good. But it is still the case that the shining light is Australian shares with 5.7%. That's actually ticked down as well as markets have gone up. It was 6% last year. But it's still the case that, from an Australian perspective, you said about a retiree, I can get 5.7%. That includes the refund of franking credits from Australian shares. Compared to just about every other asset class, no wonder we love Australian shares. And that is reflected in the latest asset allocation of self-managed super funds here in Australia. The lion's share is in Australian equities, 32%. Somewhat surprisingly is that cash is still the next biggest at 24%, yet it's only yielding 2%-ish type number, even less if you're on a platform. 21% is sort of other/managed funds, and there's a lot of things in there. That can be some global shares, it can be some bonds, it can be all sorts of things, CTAs, which we talked about before. I don't think a lot of it, I don't think it's all in global shares, and the direct global share allocation is virtually nothing. So, I mean, most of the studies that have been done suggest the average retail investor is significantly underweight global shares relative to what particularly large institutions are. There's also the big yellow allocation there, the third largest allocation is Australian property. We've heard today people worried about Australian property. Cash rates are incredibly low. Australian equities have got a fair exposure to banks which have exposure to property. 70% or more of the average self-managed super fund's got a fair bit of property exposure, directly or indirectly. Yet we know, it's interesting, we know from all the studies, all the analysis, and we've done one ourselves here, that to get a truly balanced or diversified portfolio, you should have not all your eggs in one basket, but you should have a good allocation to overseas shares. In fact, in the last 5 years, you've been better off from both a risk and a return point of view to have far more of your growth assets in global shares than you would Australian shares. Yes, you wouldn't have got much income, but you would have had a much healthier return with less risk. In fact, on those numbers, the good balance for risk and returns probably 40% in global shares in the last 5 years and only 20% in Australian shares, when most people are lucky to have the flip side, which is 40% Australian, 20% global, certainly in the retail level. But I think that income, that very low income out of global shares, particularly for retirees who love to live off their income, is the reason why they are underweight global shares. So that's setting the scene, but let's now look at, can you actually deliver or build a portfolio that does actually generate high levels of income, and if so, how would you do it? So first thing I want to show you is, if you have a global universe, and these are stocks that are the same size as, say, our S&P 300 universe that we look at here in Australia, and we're only looking at developed markets, but when we go overseas and we look at the dividend-paying opportunities, I mean, the world is truly your oyster. There are thousands of stocks that pay dividends, and they pay them all over the year. In January, there is just one stock in Australia that goes X. It's actually based on the X dates. It goes X in Australia. Globally, the blue line suggests there's about 400 stocks every January that go X a dividend globally. In March, our biggest dividend-paying period here in Australia, about 75 individual names go ex-dividend in the S&P 300. Nearly 2,000 go ex-dividend globally, just the developed markets, just the universe, same size as Australia. So opportunity is vast. And actually, there are quite a large number of high-yielding stocks. We draw the line at 4% and said, how many stocks that are yielding over 4% per annum are there in the global universe that we look at? Again, just developed markets versus the domestic universe. About 450 stocks globally that pay dividends somewhere between 4 and 6% annual yield, and there's about another 250 with excess of 6% annual yield with no franking. In Australia, you're looking at about 60 to 70 stocks in those two buckets. So again, there's a lot more high-yielding stocks globally than there are domestically when you actually start to look at it. Yes, there are some very low-yielding stocks and some very big low-yielding stocks, and Tim's talked about a couple of them here today. And some of them won't be household names. You've probably never heard of SalMar. It's a little bit like Tassel, actually. It's a salmon producer, but it's a Norwegian salmon producer, pays a 6% annual dividend, and what's more, it pays it in one hit. So you only have to own it for a couple of months, get 6% income, and then you can move on. Rogers Sugar is a Canadian sugar refiner and distributor. Again, pays a 6% yield, not quite so juicy because it's quarterly dividend paying, which North American companies mainly are. So if you actually look for these hidden diamonds, they're there. But it's not like they're names that no one has ever heard of, and they might be small companies. I mean, SalMar, something like a market cap about $2 billion. So it's actually a fairly sizable company. But there are actually quite a few household names that pay reasonable levels of dividends, talking sort of 5% type marks. Singtel, GlaxoSmithKline, you may have heard of it, but I'm sure just about everybody in this audience had a Panadol one day. They actually market Panadol, and Nicorettes if you're addicted to tobacco, they sell those as well. Ford, if you looked at Jacob's slide before, you'd actually see Ford sells about the same number of electric vehicles as Tesla, and it's actually got a lower market cap, and it pays a 5% quarterly dividend. We like companies that pay 5% quarterly dividends. That's not bad in a global context. AT&T is similar. The one that's a little bit lower there is, I've thrown another pharmaceutical company, healthcare company, Roche in there, Swiss company. It only pays a 3.4% yield, which, okay, that's not great on an annual basis. But again, it's a bit like Salmar, pays it once a year. You only need to hold it for a little while to get the 3% income, which fits very nicely with actually how we manage money. For those of you who've seen us present on an Australian process or even on our global process, you're probably familiar with this slide. This is a slide, it's all about what we call the dividend run-up. It is the phenomena that, not just in Australia, but globally, in every market that we've looked at, that dividend-paying stocks outperform other stocks that aren't paying dividends at the same time by 2, 3, and in case of Germany in the red line, they're 4% over a couple of months, over 2 to 3 months. It seems that certain investors love income and they like to buy them up. If you want to get the income, you've got to buy the stock before it goes X. You buy it in that period, the stock goes up. We love that because we can buy it, hold it for a couple of months, get even Roche 3.4% dividend, Salmar 6% dividend, hold it, and then move on, buy other stocks. And so by rotating through stocks, by looking for high yield stocks, but rotating through stocks that pay dividends, that's how we can generate much higher income than the market. So this is a very fast presentation, but we asked the question, can global equities provide good income for retirees? Hopefully they can, because we show you that income is still very hard to find in the traditional income yielding asset classes like bonds and cash. You all know about the benefits of global diversification, and we looked at those, and indeed there's an argument for both reducing risk and indeed for the last few years increasing returns by going to global equities. And can you deliver high income out of global shares? Well, if you look hard enough, you definitely can. After fees, after withholding taxes, we have delivered 6% distributed income, all dividends, not capital gains, all dividends out of our global shares income fund over the last 18 months, compared to an index which over that same time period delivered around 2. So the answer is yes, you can. If you look hard enough, you can have your cake and eat it too. You can get the diversification benefits and not actually give up the income opportunities by going to global shares.